Hello and welcome to Unacademy, a one-stop destination for all the English medium civil service aspirants. Welcome to another session of Economy Weekly Recap, wherein we take all the important economy-related articles which have come in different newspapers in the last 1 week and we analyze these articles. Now, before I start the discussion, two very important announcements. The first one, we at Unacademy are very happy to launch UPSC online classroom programs for English medium aspirants, Hindi medium aspirants, and those aspirants who want both Hindi as well as English, that is English. As part of this programs, we are going to provide a complete coverage of syllabus for both preliminary examination as well as mains examination. We will provide unlimited access to the batches for you students. We'll provide a comprehensive study material. And let's be very honest here. In the course of preparation, I'm pretty sure many aspirants, even now you people might be facing certain issues, certain doubts. You want somebody to provide mentoring to you. We provide 1:1 mentorship facility. And not just this, one very important aspect of UPSC preparation will be to attend the prelims test series so that you understand to what extent your preparation is done and in what areas you need improvement. We'll provide you the preliminary test series as well as mains test series. If you are interested, please give a call to this number. There is also a link provided in the description section. Please check out the link. In addition to this, second very important announcement, one very important area that you need to focus in order to score very high, get very good rank in the civil service examination is the optional subject. We are launching optional subjects for civil services examination. The classes for PSIR, both English as well as Hindi are being conducted. We also have a history optional course. We are providing geography optional. We are providing optional for PubAd, maths, sociology, anthropology, as well as agriculture. Based on your options that you have taken, if you need guidance in any of these optionals, please call on this number. And for the details for the program, a link is provided in the description section. Please check out. Now, let's start the discussion. The first very important article that I want to discuss with you people, which grabbed a lot of headlines in the last 1 week, is private sector investment has declined by 15%. Now, before looking at the factual information, the data given in the table, let's understand the basics here. Point number one, whenever you talk about GDP, gross domestic product, you'll definitely come across a concept of GDP calculation through expenditure method. There are three methods. One is the income method, second one is the value addition method, and the third one is the expenditure method. And the formula for expenditure method is written like this: GDP is equal to C plus I plus G plus X minus M. In this, I'm focused on the second component, that is I. I basically is nothing but investment expenditure. And when I say investment expenditure, whose investment are we looking at? We are looking at the investment expenditure done by the private sector. Please remember this, private sector. And generally, the gross fixed capital formation, GFCF, is taken as a proxy for representation of the private sector investment, which is representing I here. And what is the importance of the private sector investment? Please understand this. Whenever you want to achieve a higher GDP, and as such, I'm pretty sure all of you know this by now, Government of India says they want to make Indian economy, that is GDP of India, worth $5 trillion. And in order to achieve $5 trillion, you need a lot of investments. Investments from the domestic market, investments from the foreign market, and investment from Government of India. But the problem is, if most of the investment which is going to contribute to GDP, let's say comes from the government. If lot of investment or majority of the investment comes from the government, this kind of growth is very difficult to sustain. It's not easy. Why? From 1 year to next year, government of India has to keep aside, has to keep on earmarking lot of money to be spent for promotion of investment which will contribute to higher GDP. Rather than that, government when they invest, they would prefer that private sector will look at it, feel very confident about the growth of the economy and start investing more and more. And generally, these kinds of investments will be represented in the form of capital formation. In the concept of capital formation, the basic idea of a capital formation is from 1 year to the next year, how much more capital is getting added because of investment. That is measured in the form of gross fixed capital formation. Now, why it is important? Reason is simple. Higher GFCF generally means investment is increasing. Investment has a multiplier effect, which means GDP will start increasing. Higher investment will lead to higher employment generation, right? So on and so forth. So that is the importance of having high private sector investment in the domestic market. Historically, if you see, in the beginning after independence, the savings rate in India were very low. Over a period of time, savings rate have picked up, and with the higher savings rate, even the investment rates in the domestic market have been picked up. Now, those who are wondering, you started with investment and now you're talking about savings. Logical reason is simple here. Higher is the savings rate. You will use these savings and these will become investments in the market. And that is the precise reason we generally say the household savings are so important in India. Because if you take the total savings of the domestic market, somewhere around 60% to 70% of the total investments, total savings come from the households itself. So going back to the original point I was making, historically the savings rate were very low. Over a period of time, the savings rates have picked up. Especially post LPG reforms, savings rate have hit, investments rate have hit more than 30% of GDP in India. But post 2007 and 8, global financial crisis, the investment rate, gross fixed capital formation has actually come down. Even today, we are struggling to reach the highs that we experienced back in the year 2005, 6, etc. in terms of investments as a percentage of GDP in Indian economy. But having said so, please understand, it's not that government of India has not done anything in order to promote investments in the market. For example, government of India has liberalized FDI. Very recently, they have liberalized FDI policy for attracting electric vehicles in India. Space investment, the electric vehicle manufacturing and investments in the space sector. They have made it very easier to conduct businesses in India. They have basically implemented a lot of reforms to attract foreign investments in the domestic market. Best example is PLI, Make in India, etc. But having said so, the article says the private investments in the financial year 24 has dipped by 15%. What are the reasons behind it? And what are the factual information that you need to focus upon? You do not have to remember the complete table, but please understand, according to the table mentioned or table given here, the total investments for the financial year 24 is around 35 lakh crore rupees. 35 lakh crore rupees. And out of that, the important area which has attracted a lot of investments is manufacturing sector. But more importantly, if you compare to the previous number, how much investment has come into manufacturing sector, the dip or the fall is around 40%. Apart from manufacturing, there are various other areas which have not attracted or which have attracted lesser investment compared to the previous year. But the highest dip, highest fall is observed in the manufacturing sector itself to the extent of 40%. And overall investments have declined by around 4.8%. But if you look at it, investments can come from the government also, can come from the private sector also. The private sector investment has declined by 15%. And generally the reasons why investments decline in any market. Why investments decline in any economy, right? And these are applicable specifically for Indian economy right now. Are these: one, the demand for goods and services is expected to be lesser. Again, when I say lesser, we experienced pandemic, and during pandemic, for the demand for goods and services took a hit, and various experts, various company insiders, or let's say the companies, they are still arguing that there is a revival for the demand for goods and services, but specifically in the FMCG segment, especially in the FMCG segment, the goods which we consume on day-to-day basis, the demand for such goods is yet to revive. And that's the reason there is a concern investments are not increasing at a faster pace. Second issue is the election season. Election season, the argument of the private sector is that elections are being held in India. After the elections, government will be formed. The government will have its own policy. They will come out with their budget. So until unless we know what would be the policy of the government, we cannot commit to the investments. We cannot simply commit to the investments right now. So that's the reason they have tempered their investment proposals for the current financial year. And the third very important reason why investments have taken a hit is because many companies are saying they have already invested a huge amount of money. In the last couple of years, they have already invested a huge amount of money. And they already have sufficient capacity. But because of various issues in the domestic market, they are not able to utilize the complete capacity. There is certain unutilized capacity which is there. And that's the reason the private sector companies say, I'm not going to invest when there is already unutilized capacity with me. If the capacity is utilized and there is still demand in the market for goods and services that I'm manufacturing, then I will invest, I'll produce more and satisfy the demand. So these are some of the reasons why there is a lower, right, investment from the private sector. Having said so, the article also says there is a rise in the investments done by the states. The state capex, capital expenditure, is rising. But there also many experts have cautioned saying that even the states, many of them are concerned about their fiscal deficit. Because the policies of the government of India have changed now regarding how the lending will be allowed to be done by the state governments. To be very precise, if you have read about Kerala versus the central government regarding restrictions imposed by the central government, you will realize it. So various state governments, if these kind of policies were not implemented by the center, they would have borrowed more money, invested, spent more money under capital expenditure. But because of the concerns regarding the new calculation methodology of borrowing limit imposed by the center on the states, the borrowings are also lesser. The investments done by the state governments also have been tempered. So these are certain very important points regarding the article given here. Now, based on this, I've given a descriptive question or question for a descriptive answer. Among several factors for India's potential growth, the savings rate is the most effective one. Do you agree? What are the other factors available for growth potential? Understand, this question was asked by UPSC in one of the earlier examination for civil services. Argument is simple here. There are many factors which can contribute to growth in the economy. But out of that, savings is the most important one. That is first part. Second part, apart from savings, what are the other areas that can contribute to growth in the economy? Argument is very simple here. You can write certain points regarding the savings rate in India, how savings will help in converting into investments, converting into capital formation, that you can write. Apart from savings, what are the other areas that can, or what are the other factors that can contribute to growth in India? You can talk about demographic dividend. You can talk about, right, let's say the investment in the technology availability that can contribute or that can drive the growth in the economy, right? The manufacturing sector that can drive the growth in the economy, etc. There are different areas or different factors that can contribute to growth in the economy. So this is basically the model answer, or let's say the snippets using which you can answer to this kind of a question. Now let me go to the next article. IFFCO's Nano Urea Plus. Now what is this? Let's try and understand the basic points first. Point number one, I'm pretty sure all of you know this by now. In case of India, agriculture sector requires a lot of fertilizers. But the demand for the fertilizers is so high, we are not able to meet the demand with the domestic production of fertilizers. And as a result of this, we import a lot of fertilizers. Clear? We import a lot of fertilizers. But the issue is that in the international market, whenever there are certain disruptions, for example, Russia-Ukraine war, or for example, the prices of crude oil will start increasing, natural gas prices will start increasing, that will have a direct bearing on the cost of imports that are done in India. And not just that, when the cost of imports will start rising, the government, in order to ensure that the fertilizers are sold to the farmers at a subsidized prices, at affordable prices, government will provide lot of subsidy on the fertilizers. That is also cause of concern. In addition to this, India imports a lot of chemical fertilizers. Farmers use lot of chemical fertilizers. And there are certain issues. There are certain environmental factors that need to be considered whenever you consume. Consume means whenever you use such a huge amount of chemical fertilizers. So, Government of India, not to address all of these issues, has been promoting production and usage of a type of fertilizer called as nano urea or nano fertilizer. And the article discusses about nano urea. So let me stick to the concept of nano urea. The largest fertilizer cooperative in India, that is IFFCO company, has been allowed by Government of India to manufacture nano urea and sell it to the farmers. But more importantly, in 2021, Government of India issued a directive, issued an order. Under this order, they were supposed to manufacture nano urea and sell it. And according to this order, the nano urea will have 1% to 5% by weight of nitrogen. What is the meaning of the order here? Simple. Whenever you manufacture urea and sell it, whatever is the weight that you are selling, 1 to 5% of this weight will consist of nitrogen in this fertilizer. For example, if you're confused even now, let's say you will purchase a fertilizer worth 100 kgs. 1% to 5% of that fertilizer will be nitrogen, right? A nutrient present in the fertilizer. Now, what was the issue? Issue is very simple. If you compare this presence of nitrogen in the nano urea with chemical urea, chemical fertilizer, in case of chemical urea, the 46%, remember this, 46% of the chemical urea will be nitrogen. So on one side, you have nano urea, which government is promoting, which government is recommending farmers use it, has 1 to 5% nitrogen, but chemical urea has 46% nitrogen. So farmers automatically will be attracted more towards chemical urea rather than nano urea. And that is exactly what happened. And because nitrogen is very high in chemical urea compared to nano urea, productivity would be much higher here. Efficiency of this would be much higher. So farmers, even though government promoted nano urea, farmers were still interested in chemical urea. And what many of the states did was, when they were selling this chemical urea to the farmers, the shopkeepers forced the farmers, tagged the nano urea along with the chemical urea and sold it to the farmer. Meaning what? If I go to a shop and I want to purchase, let's say, this chemical urea, the shopkeeper basically told me, if I want to purchase this, I will also have to purchase nano urea. This kind of a tagging or clubbing was done. So farmers looked at the issue of productivity and looked at the issue of tagging, or let's say clubbing, which was done by the many of these shopkeepers, protested against it, opposed it. And that is the precise reason center had to issue a directive not to sell nano urea clubbed with chemical urea like this, not to force sell these goods after clubbing to the farmers. Now, what has happened? 2024. We are in 2024 now. So, this order was issued. 2021, 3-year duration. Now, one more order has been issued for 3-year duration. According to the new order, government says the IFCO company will manufacture one more variant of nano urea. They are calling this as Nano Urea Plus. Nano Urea Plus. And under Nano Urea Plus, the company has to manufacture nano urea with at least 16% by weight having nitrogen. Is it okay? At least 16% by weight having nitrogen itself has to be manufactured in the form of nano urea now. So this is basically the article that is given here. I've gone beyond what is given in the article so that you understand what is the importance of this kind of a newspaper article. Now, based on this, I've given an MCQ with reference to chemical fertilizers in India. Consider the following statements. At present, the retail price of chemical fertilizers is market driven and not administered by the government. Some of you, or let's say many of you, will feel yes, this is absolutely correct. I have one word for you. What about urea? Urea, chemical urea, that is the word. In case of chemical urea, the farmers, when they will purchase from the market, the price is decided by the government. The price is decided by the government. I can manufacture urea, I can sell it at a higher price, but government says no, that's not allowed. You will have to sell it at a price decided by the government. Right? So can I call this as an administered price? So statement 1 is wrong. And some of you will ask me now, sir, if government will decide what is the market price of urea and you sell it at a much lower price, what will happen to you? Will you not incur losses? Of course, yes. If government doesn't provide any subsidy to me, which government does in this case, I will sell it at the price quoted by the or decided by the government, and whatever is the actual price of this urea and the difference between the price decided by the government, the difference between both of them is given by the government as subsidy to me. That is basically the concept of subsidies in case of urea. Now, before I go forward, Government of India also provides the subsidies for the diammonium phosphate as well as muriate of potash. But please tell me, what is the methodology? What is the name of the methodology used by the government to provide subsidies for diammonium phosphate as well as muriate of potash? If you know the answer, please write it in the comment section. Second statement, ammonia, which is an input of urea, is produced from natural gas. In fact, I gave a hint when I was discussing just now. I told whenever the natural gas prices will start increasing, fertilizer prices will start increasing. Reason is simple. This is right. Okay. Because of this only, the prices will start increasing. Sulfur, which is a raw material for phosphoric acid fertilizer, is a byproduct of oil refineries. Yes. Of course, yes. This is also correct. So, second statement, third statement are correct. Right option will be option B. 2 and 3 are correct. Let me go to the next article. 46 FDI proposals pending. DPIIT has a return to 17 departments. What is the issue all about? What is the importance of this article? Let's understand. Point number 1. Government of India has set up a target of attracting $100 billion per year for the next 5 years. Is it okay? I'll repeat the statement again so that it will sink into your mind. Government of India set up a target of attracting $100 billion every year per year for the next 5 years. And if you're thinking, sir, why should we attract FDI? Reason is simple. Right? The point is already mentioned in the earlier, right? Let's say discussion of the article. Government of India wants to promote GDP in India, wants to increase the GDP to $5 trillion. For that, we need to attract a lot of investments. And that is the reason. I hope you understand. And government says this is the right time. This is the right time to attract a lot of FDI. Why? Please understand this. Around the world, earlier, many foreign companies went into China or were attracted by the proposal of investment in China, have invested huge amount of money in China. But during pandemic, after pandemic, and recent frictions between government of USA and Chinese government, etc., they have realized that there is a need to diversify their production capacity. There's a need to change, have an additional base of manufacturing outside China also. And many other countries, including India, are offering this under a strategy called as China plus one strategy. China plus one strategy. The government of India itself is pitching and saying, you want ease of doing business? Come to India. You want approvals very quickly, very fastly? We will do that. Right? You want a lot of labor availability? India has. Please come into India and invest. So we want a lot of investments to come under the model of FDI into India. But having said so, is this possible? Is $100 billion possible per year? Many experts argue that this looks a bit ambitious. Reason being, if you look at the last 5 years, ending in the March 2023, the average amount of FDI that has flown into India comes out to be $70 billion. Average amount of investment comes out to be $70 billion. Right? So, if you look at average is 70 billion, now we want to target 100 billion. Various experts argue that this is slightly a bit on an ambitious level. But anyways, this is the target. Point number 2, in order to attract the FDI, in order to attract a lot of FDI into India, government of India has made various reforms in the last couple of years. For example, earlier, whenever FDI has to come into India through approval route, and those who are confused, understand this carefully. FDI can enter into India through automatic route and approval route. There are two routes, automatic route and approval route. And which sector will fall under automatic and approval is decided by the government. In case of automatic route, it is very easy to bring in investments into India. And that's the reason lot of the sectors which were earlier under the approval route have been shifted to automatic route. And not just this, in case of approval route, earlier there was one authority by the name of Foreign Investment Promotion Board, which was set up during LPG reforms. Government of India has abolished Foreign Investment Promotion Board, and we have set up one more system, Foreign Investment Facilitation Portal. Foreign Investment Facilitation Portal. Any sector that falls under the approval route and the foreign company wants to invest up to 5,000 crore rupees, then they can simply go to the Foreign Investment Facilitation Portal, apply it in the portal, and this request for approval will be sent to the respective department. And that is where the government says, or the DPIIT says, there is a concern now. There is a concern. What is the concern? Whenever any approval is sought using the portal, the approvals will have to be given in the 12-week period. Under the approval route, government says approval will have to be provided within 12 weeks. And not just these, please understand this, not just the sectors which will fall under the approval route. In fact, Government of India also has one rule related to FDI. There is one more regulation. Regulation is simple. Any investment that will come into India by through the neighboring countries or from the neighboring countries. I'll repeat my statement. Any investments that will come into India, that is FDI investments that will come into India from our neighboring countries, countries that share border with India, they will have to go through approval route only. They will have to go through approval. So DPIIT says, on one side, we have a target of attracting $100 billion worth of FDI every year. But on the other side, the companies which have applied under the approval route, many of the departments, even though the time period of the threshold time period of 12 weeks has been crossed, they're yet to provide approvals. Hence, DPIIT is saying that this will create problems. This will basically hinder the target of $100 billion, has written a letter to all the 17 departments asking them to clear all of these approvals or provide all of these approvals on fast track basis. So this is basically the discussion given in the article. Next, government to back Vodafone Idea FPO to ensure competition. Statement given by Mr. Somanathan, who is the finance secretary. Now, what are the points? Point number one. In case of India, Government of India post 1991 has implemented various reforms, as a result of which the telecom sector has opened up. And because of the telecom policy announced by the government, lot of foreign investment has come into this sector, as well as domestic investment also has gone into the sector. But over a period of time, because of various issues, many of the telecom companies either have been forced to merge with other companies, have been forced right to either get dissolved, etc. But right now, if you talk about Indian telecom sector, the important players are: one, Vodafone Idea. The discussion is about Vodafone Idea itself. Second, we have BSNL. Third, we have Airtel company, and the fourth one is Reliance Jio. Although we have four companies, already there is certain financial pressure on the functioning of Vodafone India as well as BSNL. That is the reason many of the experts are warning that from many companies that were there competing in India in the telecom sector, we might be moving towards a duopoly situation. Duopoly means only two companies will exist in the market, and that is not preferable in terms of promotion of competition, consumer preferences, options for the consumers, pricing of the products for the consumers. That is not preferable. But anyways, the talk right now is regarding Vodafone India. V means Vodafone India. Now, what has happened? Listen to the story. Important. When Government of India provided under telecom policy, provided approvals for investments in India, entry into telecom sector, they also started allocating spectrum. And the companies which purchased the spectrum for the government were supposed to make certain payment. They were supposed to make certain payment to Government of India. Now, there was a disagreement over how the or what parameters will be used, what form of revenue will be used to calculate the amount of payment that the telecom companies owe to the government. That discussion has happened under the concept called as adjusted gross revenues. So there was a full disagreement between the telecom sector companies, private sector companies, as well as the Government of India. The matter even went to the judiciary. But over a period of time, it has got settled, and we have agreed to a particular formula, parameters which are supposed to be used to calculate how much is the payment pending or the telecom companies owe to Government of India. But now there was a concern. What is the concern? What if the telecom companies, according to the formula, will have to pay certain amount of money to the government, but they don't have sufficient amount of money? In such cases, what will happen? They don't have money. The Government of India in the year 2022 came out with a policy, and under this policy government said we will allow for such companies, there is one option. What is the option? Whatever money that these companies owe to Government of India, they can simply convert this into equity. They can simply convert this into equity, meaning government will be given certain amount of ownership in these telecom sector companies if they are not able to make a payment. Now, there were two important aspects related to this. First aspect is, if government will have ownership in these companies, will these become public sector undertakings then? Government said no. These will not be public sector undertakings whatsoever. And second, instead of collecting money, why is the Government of India taking equity? Why is the Government of India taking ownership in telecom companies? Government's argument was that today the company is not doing well. I will take ownership in the company. Company doesn't have to pay money, which means it will control its expenses. It will help in reducing the financial stress on the company. Company may turn around in the future, start making profits, and the share prices of the company will increase over a period of time. And when the company is performing well, share prices are higher, I will sell these shares, recover my money. That was the argument of Government of India. And that is the precise reason this provision was used by Vodafone India, and they offered shares. They offered 1600 crore shares, which roughly translates to around 32% of ownership in the company. They offered certain number of shares, which translated to 32% of ownership in Vodafone India. Now, this is the background. This is basically the background. And that is the reason I hope you understand now why the finance secretary is arguing and saying government will back FPO of Vodafone India. Because Vodafone India is a private sector company. Why should finance secretary talk about Vodafone India? Reason is precisely this. Now, whatever ownership was allocated to Government of India, this ownership or the shares were kept under the administrative control of DIPAM. These were kept under the administrative control of DIPAM, Department of Investment and Public Asset Management. Point number 4, Vodafone India now has proposed FPO. It has proposed an FPO. What is an FPO? Follow-on public offering. And under follow-on public offering, a listed company will issue more shares, more equity in the market, raise capital. And Vodafone Idea says they want to raise capital to the extent of around 18,000 crore rupees through FPO and use most of it, around 60%, 70%, around 60% plus of it. They want to use it for the development of infrastructure, capital expenditure, so that they'll be able to offer more services, new type of services, acquire more customers. This is basically the discussion related to the article given here. But in addition to this, there was one very interesting concept that was mentioned in Indian Express related to Vodafone India's FPO. The concept was anchor investors. Anchor investors. Now, what is this idea of an anchor investor? Listen to me carefully. Whenever you talk about IPO, FPO, etc. like this, according to the SEBI, certain amount of shares, certain amount of equity has to be distributed, right? Whichever shares or how many shares you are issuing, those have to be distributed amongst 3 types of investors. One is called as institutional investor, and anchor investors, these are experts, these are institutions which are part of institutional investor. Second one is non-institutional investor. High net worth individuals are part of it. And the third one is retail investors such as you and me. And whenever IPO is done, the SEBI mandate says half of the shares will have to be reserved for the institutional investors itself. But more importantly, understand this. What is the role of anchor investor? What is the role of an anchor investor? Whenever a company goes for an, right, let's say public offering like this, one day before the offer opens to the public, one day before the offer starts, the shares are issued to the anchor investors. The equity is issued to the anchor investors. And the argument is very simple. Anchor investors, if they subscribe, purchase the shares at a fixed price from the company, it shows these are experts and they have confidence over the company. They have seen certain performance indicators in the company, and that is reflected when they will start purchasing the shares. And this is a very good indicator for others also in the market. For example, you and me, we may not understand whether the fundamentals of the company are strong or not. We may not understand how the order books of the company are arranged. Are they receiving orders? What is the customer base, etc. Right? So these experts, right, the institutional investors, these are experts. They will have a better handle over the information assessment of these companies. And if they start investing, it's an indicator for others also on the next day to purchase the shares which are being issued under the public offering. These are called as anchor investors. Okay. Now, these are certain points regarding the concept of Vodafone India and its FPO. Next article, after modules, government now plans non-tariff barrier for solar cell imports. What are the points? Point number 1, Government of India has kept a huge target for renewable energy. And within the renewable energy, the total target is 500 gigawatts by the way. Under the renewable energy, we also have a huge target for solar energy. But the concern regarding promotion of solar energy production or solar energy capacity in India has been that we are import dependent. For solar cells, solar modules, we are import dependent. And it will not be surprising to you when I say this, most of the imports that we receive in India come from China. That was a point of concern. So government wants more and more production in the domestic market to happen, but our dependence on the imports is very, very high. In order to reduce the import dependence and also promote domestic manufacturing, government initially imposed safeguard duties. But the safeguard duties were imposed for a very limited period of time. After that, safeguard duties were withdrawn and government imposed customs duties. Right now, on solar cells and modules into India, it attracts customs duties 25% and 40%. And the logic behind either the safeguard duty or the customs duty is simple. The imports will become more costly, prices will increase, and this will force the companies in India developing these parks or developing these let's say projects to purchase cells and modules from the domestic manufacturer. That was the idea. In addition to this, government back in the year 2019 introduced a new system called as ALMM. ALMM. What is this ALMM? Approved list of models and manufacturers. Approved list of models and manufacturers. And what is the basic idea of ALMM? Logic is simple. Imagine I'm a manufacturer, right? A manufacturer of a solar models. If my name is there in this list, that is under the ALMM, any company which is developing a solar park, which is financed by the government, which is backed by the government of India, that developer is allowed to purchase models from only me. If let's say there are 4 companies, X, Y, Z and A, who are listed in the ALMM, any project which is financed by the government, which is backed by the government, the developers of these projects will have to purchase the solar models only from these 4 companies or developers. This is basically called as ALMM. And the argument behind ALMM, which is applicable right now only for the models, please understand this, or modules right now, please understand this. If these developers will purchase from these companies and these companies are set up in India, automatically the imports done will come down and manufacturing in the domestic market will improve. That was the logic of ALMM. And that is the reason many experts argue that ALMM is nothing but a non-tariff barrier. And those who are confused, what is a non-tariff barrier? The imports or exports from a country or to a country can be restricted by imposing restrictions. These restrictions, if these are in the form of taxes, these are called as tariff barriers. And if these are in any other form, these are called as non-tariff barriers. ALMM is a non-tariff barrier. And now government of India says that we can use the same non-tariff model for restricting solar cell imports as well. Those who are confused, sir, what is solar cell, what is solar module, etc. Please understand this. Imagine a Parle-G biscuit. I'm pretty sure all of you have eaten a Parle-G biscuit. Many of you have opened the Parle-G biscuit packet. Now imagine a packet. This packet is nothing but a model, solar model. And you open the packet, you will see multiple Parle-G biscuits stacked one above the other like this. So solar cells, these are nothing but solar cells. Solar cells are packed together and that is called as a model. Right now ALMM is applicable only for solar modules. Now government of India wants to bring even the solar cell under the ALMM, which basically again the objective is simple. Domestic production will be promoted. Demand for these, that is manufactured, cells manufactured in India by companies will also be promoted. Import dependence will come down. This is basically the gist of the article provided. Next one, USA, European diamond buyers are asking exporters to declare source. Now, what is the issue all about? What are the important points? Point number 1, India is a country which is known for polishing and exporting diamonds. Please remember this. India is very well known in the global market for polishing and exporting diamonds to the international market. We export these diamonds to European market. we export it to USA market, we export it to the Middle Eastern countries, etc. And in the last couple of years, because of various events that are taking place outside India, diamond exports have come under stress. In fact, many of these diamond exporters had to cut down the number of labor, had to reduce the capacity utilization, and in many of these diamond exporters, half of the capacity utilization has remained unutilized. Reasons are simple. When you're exporting these diamonds, let's say to USA, if there is a recession in USA, if there is a very high rate of inflation in USA, if you're exporting into, let's say, Middle East, and there are frictions which are happening in the Middle East, as a result of which there is a disturbance in the economy, all of these automatically will reduce the demand for the exports of diamonds done from India. And that is the reason the diamond exports have come down, and the manufacturers of these also have experienced stress. And why is this important? This is an area which is labor intensive. Please remember this. This is one industry which is labor intensive, which means a lot of labor is generated in this particular region or in this particular industry. And it's not the only industry which has come under stress, which is labor intensive. All of you heard of textile sector? Textile sector, even the textile sector is also labor intensive. But in the last couple of years, even this particular sector has come under pressure. Now, what has happened? What is the issue all about? Reason is very simple. Article simply says, out of the 10 diamonds which are cut and polished, 9 of them are cut and polished in India. Out of 10 polished diamonds, cut and polished diamonds around the world, 9 are cut and polished in India. And we also export a lot of these to the international market. But very recently, there is one rule which has generated or which has led to concern in diamond manufacturers or exporters in India. And the rule is simple. USA and European Union, from 1st March, they are mandating source certificate, which is, they are saying that if the diamonds originate from Russia and they're routed to a third country, we don't want these diamonds. We do not want these kind of diamonds. Why? We want to punish Russia for annexation or for their attack on Ukraine. So what we want is, any exports that are done into these countries starting 1st of March, such as Indian exports of diamonds, they will have to provide a source certificate, which many of these exporters are saying is a cumbersome process. It's one more additional layer of documentation, which is difficult for all of these companies. So they have raised a concern regarding this new rule. Next one, the last article for the day, 59-minute loan portal of government has sanctioned over 86,500 crore worth of loans. This article has appeared on Hindustan Times newspaper on 15th April 2024. What are the important points? Let's try and understand. Point number one, earlier Government of India felt that many of these borrowers in the market might find it very difficult to get access to institutional credit. And even if they get access to institutional credit, lot of documentation requirement will be there. For example, let's say I'm a micro enterprise owner. I will have to run from bank 1 to bank 2, 3, 4, 5, 6 banks to come to know what kind of loans they are offering me. And not just that, the bank manager might ask me for GST bills, that is GST file returns documents. The bank owner might ask me income tax receipt documents, etc. All of that is a cumbersome process. So Government of India felt we should have a new system which will make it very easy and accessible for borrowers in the market to get loans. And as a result of this thought only, in the year 2018, I repeat, in the year 2018, Government of India, along with the SIDBI, set up a new portal, PSB Loans in 59minutes.com. PSB Loans in 59minutes.com. This was the new portal which was set up by Government of India, again through SIDBI. The argument of Government of India through this portal is that many banks are registered on the portal. Now, let's say there's a micro enterprise owner who wants to get information regarding what kind of loans are offered, what kind of documentation is required. Can they do it online itself, etc.? They can register, log on to the portal. Many of the banks are registered here. All their products will be made available online. Information is available online. So I, as a borrower, will choose one product offered by a bank, will apply for that particular loan online itself. What kind of loans can be applied now? Auto loans can be applied. Housing loans can be applied. The personal loans can be applied. Mudra loans, MSME loans, many types of loan products are available through this portal itself. And not just this, the government also says that the number of loans which have been issued, applications which have been accepted through the portal are more than 2 lakh applications. And more than 86,000 crore worth of loans have been issued to the applicants who have applied through the portal. Right? And apart from this, government is also saying that lot of integration of data has happened. That is, let's say a bank which is registered on the portal, if they want to know whether I'm paying income tax returns, that information is available through integration of the system. They can get it from the backend. If they want to know, am I filing my GST returns? That is also available. Lot of integration of data has happened, which will make it very easier to assess the creditability, or let's say whether the borrower is a good borrower or a bad borrower, credit rating of a borrower, etc., can be assessed using this particular system itself. Right? So all of these are certain points which have been provided regards to the 59-minute loan portal article given here. Now, based on this, I've given a very easy question. Using 59-minute loan portal, loans for which of the following may be applied? Mudra loans, home loans, auto loans, and personal loans. All the 4 loans, right? For all the 4 loans, you can use the portal to apply. So the right option will be option 4, all the 4. So these are the various articles as well as the concepts related to the articles that I wanted to discuss with you people. If you like this initiative, please hit the like button. And if you yet to subscribe to our YouTube channel, kindly do it now. Thank you. Have a great day.